Welcome to my monthly update on alternative asset fund administrator and auditor league tables. There are over 600 fund administrators and 500 audit firms servicing the private markets. I'm George Evans from Convergence. Convergence is a data and analytics firm focused on the asset management industry globally. Note that alternative asset league tables are only made available to Convergence clients. League tables can be purchased at the Convergence e-commerce website, and that's convergenceinc.com. I will provide some commentary on the movement we saw from September 2020 to September 2021 in the market. I'll be joined this month by Fletcher from BNP Prime Services. BNP, a Convergence client. Fletcher is the co-head of sales at BNP, is certainly a firm with noteworthy performance over the last year. Fletcher and I will discuss some of the very interesting topics that are very relevant to prime brokers at this point in time. All right, Fletcher, thank you very much for joining us today. I thought you might spend a little time just kind of taking our audience through kind of your roles and responsibilities at the firm.
Yeah, so I co-head the Prime Services Sales Group at BNP Paribas with Ted Post that oversees prime brokerage, total return swaps, and we've actually recently, which we may be talking about later in this conversation, fused the prime brokerage group with the secured lending groups in fixed income. So it will include bank loan lending and repo sales as well. And this is, off the back end of the recent transition of the Deutsche Bank business over to BNP Paribas and creation of the new prime brokerage platform within BNP.
Yeah, terrific. Well, I know the last year or two has been pretty busy for you given the DB transaction. So, there are a few questions I wanted to talk about today, and maybe I'll jump right to the one on service provider consolidation. Obviously, you guys have done the most recent and largest prime transaction amongst other services in the market. Interested in just your views, right? When Convergence, we see a big ecosystem, right? We see 600 fund administrators, 1,200 custodians, 500 audit firms, but believe it or not, there's over 300 prime brokers. And you definitely have the 90-10 rule in terms of primes who control the bulk of the transactions in the industry. But interested in your views just on that whole topic of consolidation, particularly in your industry.
Yeah, I think so. Consolidation among service providers, I think in certain areas is inevitable. And to kind of put a definition around it, I think if you're offering a specialized service, or if your services are kind of isolated and are like your competitive marketplace, I think that's the environment where it's inevitable to see in kind of the life cycle of business and the life cycle of the marketplace consolidation. You start out with kind of proliferation, competition, efficiencies are established, price comes down. But if the consolidation is between businesses that look and feel much like each other, and the main difference is a cross cut of the client base, or maybe some significant but kind of understandable advancements in technology, or maybe just slight differences in personnel, that's where you see consolidation. I think over the course of it's really the past 10, 15 years, as you break apart bundled services for hedge funds with administration, accounting, custody, et cetera, those isolated business lines are ripe for mergers and for consolidation. I think they're at the place in their cycle where we're just going to see more of it. I think administration is kind of a classic example. You had a lot of competition in the space as administrators became independent from prime brokers, 10, 15 years ago. The services have kind of become sophisticated enough, and this isn't a knock, but commoditized enough where there's room now to consolidate. And so when you look at a business model where, the base operating cost to run the company is fairly fixed. So let's say you have a company that will take away administration, but it produces widgets. You have 100 people in the company, and with 100 people, that's kind of the minimum that you need to operate, and you can support 10,000 clients. And we have an environment right now with a lot of these service providers where you have the equivalent of 100 people working. You have about 5,000 clients with a couple companies. And so merging two companies together where you can get, close to 10,000 clients, and then there's the efficiencies of moving back down from 200 personnel combined to 100 personnel combined. That's just, that phenomenon works across industries, and I think is happening in the service provider space. In terms of prime brokerage or businesses that are a component of a larger organization, so prime brokerage is kind of a subcomponent of a bank or a subcomponent of a broker dealer. Yep. I think that makes the mergers a little bit more difficult. You don't necessarily have like for like comparisons in not just the technology and plumbing of the business itself, but it's the compatibility of the technology and plumbing of the business with the rest of the firm and the rest of the business lines. And I think the more you kind of bundle and tack on services that start to differentiate peers from each other, the more difficult it makes to merge. So I think prime brokerage consolidation at the smaller broker dealer level, there's certainly potential. At the large bank level, and we've certainly experienced it, ourselves, it's rare to see. It usually takes kind of a disruption event to have that take place. And for us, we're at the tail end of a 2-year project that has been extremely intensive. And these are, this takes a tremendous amount of focus and dedication from BNP as a bank, well beyond just the prime division. So it's a significant undertaking, and I think that creates a pretty high barrier to entry in terms of future significant mergers of prime platforms.
Yeah, I think that's well said, because I was listening to you. I think about my 12 years at JP Morgan, and our strategy was to bring the entire firm right to the client, and there's only a handful of firms in your industry that can do that. And you also see, and you kind of alluded to it a little bit, the difference between, think about a U.S. only prime, right, versus a global prime, right, and those types of things impact, right, that whole consolidation or merger potential, right. Well, that's terrific. Let me go to a second question, and you've kind of referenced a few things, but I wanted to just talk about the alternatives market, right, and some of the trends you're seeing, from your seat, right. We're certainly seeing major growth in closed end, right. So we're seeing significant new funds, new assets in the EVC real estate front. But we're also seeing significant growth in hedge fund assets, but more money pouring into existing funds as opposed to lots of new hedge funds, like we're saying, So the market is the alternative market's huge. Just the SEC market's over 25 trillion now. So curious, Fletcher, your thoughts on some of the top trends that you're seeing, from the catbird seat, relative to alternatives.
Yeah, I think I'll repeat back or underscore maybe some of the things that you mentioned, that the trend of private equity and private credit continues. Private credit, it's kind of an extension of the shadow banking, and that continues to be robust. We continue to see capital allocated in that space, and private funds very active in the direct lending market. On the private equity side, that is, also kind of proliferated through not just your traditional private equity firms, but, many of your name brand large multi-strat hedge funds have private equity arms now as well, or mixed strategies where they have, public investments, commingled with private investments. And you see this in the marketplace. There's a tremendous amount of support in the stock market, but you see any name get knocked down 20, 30%, and pretty soon after you see it getting taken private. So I think that trend will continue. And we certainly have, plans within the bank to adjust for that and continue to support, the extension of credit to the alt space. Some other things that we're seeing, in terms of capital movement into, large existing funds, that, we certainly see the capital movement into multi-strats. A lot of those also happen to be, some of the large, long-standing hedge funds. There's one, kind of two sides to it. One, allocators are looking for fixed income alternative return streams, and looking at multi-strat return streams as kind of a reliable source for that. The other is there's just been a tremendous amount of acquisition of talent, so like intellectual capital, by multi-strats and platforms. So, there's been a poaching of talent among hedge funds, pulling in PMs, from other hedge funds that are kind of single line strategy into multi-strats and into PM platforms. And there's also a poaching of talent from the sell side, significant poaching of talent from the sell side to bring in traders into hedge funds, whether it's a multi-strat hedge fund, again, or PM platforms. But that's where we're seeing a material amount of growth. And I think the adjustment on the part of these large established hedge funds is to continue to grow via acquisition of talent, to diversify their return streams, to adjust for what allocators want. I think allocators have taken trust in the management, almost as if, treating a multi-strat hedge fund as if it's a, large asset manager and kind of full-scale asset manager. And the conversations now are kind of like an advisor would have, with a personal investor, about where they're seeing trends. And, we're seeing a lot of our hedge fund managers adjust to that by, instead of taking the current talent pool that they have and trying to extend into new strategies, they just hire on new PMs.
Yeah.
And that's what has helped, the big get bigger, but continue to justify the increased capital base, to operate their strategy.
Yeah, your point on talent is interesting because there's almost the opposite in the service provider industry where, especially we're hearing, and I'm not sure what you think about it from a prime side, but, certainly on the fund administration side and the audit side, there's this war for talent right now. These firms can't find enough talent. And, and this all started kind of at the beginning of COVID. So it's an interesting contrast, right? If you think about it, kind of two very different talent situations we're seeing right now. So, all right. Well, Fletcher, moving along. So right around the corner to 2022, and certainly not looking for you to give me the secret sauce, right, at the firm, but interested in kind of what you think your top kind of agenda items are for next year as a business.
Yeah, and happy to give away. We don't need to keep some of the good sauce secrets. So the things that we're focused on, and we feel we're very well positioned, to be a material provider in kind of both of these areas. One is quant, which probably isn't a surprise, with the platform that's now been built and fully functional at BNP. So global quant, prime, synthetic, direct market access in Asia, Europe, and US, but really an extension of our quant infrastructure and risk policies to accommodate systematic credit strategies as well. So that's one of the other trends that we're seeing is, lots of the largest quant managers have been working on credit models for years, and some of these now are, going live and into production through, with either standalone funds or as part of the larger complex. We have set up multiple risk policies and an infrastructure here to be able to support those strategies in the same way that we have kind of led from a tech and risk and securities processing standpoint for global equity strategies, global equity quant strategies for the past 15 years.
All right, terrific. That's great. And, that it kind of leads me to my last question. And really, I'll just kind of put it out there, Fletcher T, is, what are your thoughts on just kind of the next generation PB, right? The next generation prime. What's different? What might they look like? What are some of the things that you guys kind of think about, 5-10 years down the road?
So 5-10 years down the road, I mean, if we're going to 10 years down the road, I do think that there will likely be, it's a slow rolling business, but in spite of that, I do think that there's room over the next 10 years for some fintech, integration into the prime finance space or into the banking system. If it's not a, disruption event and then acquisition by the banks, then maybe it's kind of an independent competitor. But I do think that the area of, electronification of security identification is, has such tremendous room, to add efficiencies to the process, not just in the prime space, but really in the banking space of, managing KYC, which is tremendously burdensome, not just for clients, but, especially for banks in terms of the amount of personnel who need to kind of govern this process and the ongoing, annual requirements to keep everything updated. Establishing, electronic verification of information and an easy exchange of information, is an area that I think the overall banking system is in dire need of, but certainly lends itself to the prime space. I think in the prime space in particular, and along the same lines, if you're able to add, or I should say decentralize security identification in terms of market risk ownership versus security identification associated with a collateral pledge. So you have a security identifier that can be exchanged, if you will, to pledge that asset as collateral, and then a security ID that can be exchanged to transfer the market risk of the security. That I think is a powerful tool, and certainly something that looks to be on the horizon in the fintech space. And I think that that's something that could fundamentally change the way that, secured lending works, which, certainly impacts repo, margin lending, and total return swaps. One of the things that I alluded to earlier is the fact that we have, in addition to, bringing on the infrastructure of the former DB Prime platform, is we've merged repo financing, bank loan financing, and securitized product financing all under the Prime umbrella. So Prime Credit is kind of the new name that this combined business unit is operating under. But I can't underscore enough the importance of this restructuring and the value it can add to financing fixed income portfolios. Combining inventory and the efficiencies between repo and prime, having one omnibus source of inventory to supply short access is tremendously powerful. but also having the fungibility of products, being able to go to a hedge fund and truly be agnostic and allow the flexibility to be creative between lending to them via repo, total return swap, special purpose vehicle, or margin lending, and have those agreements kind of cross-reference each other. It's a very exciting opportunity to be creative in that space, but I think one that also is well positioned towards, where we are seeing capital flows move into multi-strats, managed account platforms, and the PM pods, where you really do need a lending provider who can handle all the asset classes that you want to operate strategies within with agility and ease.
Yeah, and because I do think you're right. I think that is where the market's going, kind of at the high end. And I think we're just kind of seeing the convergence too of fintech and regtech, right? So, each hit with a finer line, but I think, when you think about the whole Archegos, fiasco, it's certainly also brought to light, the products and the compliance and the risk products that are out there. So, well, listen, I want to thank you, Fletcher, for joining us today. It was really a great conversation. You guys have been a terrific client of Convergence, and we want to thank you. And we wish you well wrapping up the rest of the year, and a great 2022. So thank you very much for joining us.
Really appreciate it.
I do want to make some comments on market growth, kind of our league table roundup. So on the administrator fund, over the last year, advisors disclosed over 104,000 private funds. That's a net increase of 9,800 funds, up almost 10%, and assets of 24.8 trillion. That's a net increase of 3.5 trillion, up 16.5%. In terms of the distribution, the top 25 administrators won 45% of those 10,463 new funds. All other administrators won 22%, and advisors who self-administered kept about 33% of those funds. The top 25 administrators won 50%, about 1.47 trillion in new fund assets. All other administrators won 17%, and those who self-administered kept about 33%. We continue to see very strong growth year over year in private equity funds, about 10%, and venture capital funds, about 30%. Advisors on the hedge fund front disclosed close to 25,000 hedge funds. That's down about 300 funds, but hedge fund assets increased about 1.2 trillion. That's up about 13.5%. So when you think about growth in the administrator market, asset growth over that year over year period, September 20 to September 21, was about 16.5%. The top 5 administrators grew at about 11%. Administrators 6 to 10 grew pretty close to that market growth, about 15.85%. Where it gets very interesting is administrators 11 to 25 grew over 25%, and all other administrators 26 to over 600 grew over 27%. Let me talk now about the audit world. Advisors disclosed over 105,000 funds. That's an increase with auditors of over 11,000 funds. That's up about 12%. And those are assets very close to 25 trillion. And that's an increase of about 3.5 trillion, or up about 16.5%. What's interesting about the audit world is the top 25 auditors won 67% of the 10,000 plus new funds disclosed. All other auditors won 6%, and 27% of funds did not report a fund auditor. The top 25 auditors won almost 89% of the 1.45 trillion of new fund assets. On this round, Convergence continues to also see strong asset growth in private equity and venture capital and in real estate. On the hedge fund front, while advisors disclosed close to 24,000 hedge funds, slightly down, assets were up almost 1.3 trillion, or almost 14%. So lastly, when you think about distribution and that year-over-year growth in the audit world, it being about 16.5%, The big four grew at about 15.5, so pretty much at market. Auditors 5 to 10, though, grew at 33%, double the market. Auditors 11 through 25 grew at almost 22%. So that's, if you think about it, that's about 30% better than the market. And then all others grew pretty close to the market, about 16.75%. So we continue to see a great distribution. While there's some dominance at the top, we see advisors really spreading the jam and really distributing their work to the mid and down tier markets on both the administrator and the audit front. So I want to thank Fletcher for joining us this month. I want to thank him for a great conversation. They're a great client, and I will see you all in November. Thanks very much.